episode 30. When I turned 30, I experienced one of the happiest days of my life, and that was becoming a dad for the first time. If you take $49,000, invest that every year, grow it at 7% a year over 30 years, you can end up with a nest egg of $5 million. And Rafael Nadal has reached 30 Grand Slam finals, and he's won a remarkable 22 of these tournaments, putting him at the top of men's tennis. And that's just one win behind the one and only Serena Williams. Beyond MD, episode 30, here we go. Now, I was not happy with myself for missing out on Serena Williams on episode 23, so she had to get a mention here today. As always, thank you so much for taking time out of your day to join me on Beyond MD. Today's topic is alternative investments, and the guest is Joe Bakish. And I want to take a second to thank Stephen Pertato from Mandeville Private Client for making the introduction. Now, if you don't already, consider following the podcast, and you can connect with me on all social media platforms, especially LinkedIn. And if you have any questions, comments, feedback, or topic suggestions, please reach out to me at beyondmdpodcast@gmail.com. So alternatives include investments like infrastructure, real estate, private equity, private lending, and farmland. We will be hitting on all these topics today. Now, just to be clear, nobody has to go and invest in alternatives, but I think it's worthwhile learning about it. So hear me out for a second. If we look at the Canada Pension Plan and we look at its composition and performance. So as of March 31, 2022, the Canada Pension Plan was composed of 9% infrastructure, 9% real estate, 16% credit, 27% public securities, 32% private equity, and 7% fixed income. In the first quarter of 2022, the Canada Pension Plan declined only 2.9%, and the 10-year average annualized returns are approximately 10.9%. So to help us demystify alternative investments, I have Joe Bakish. And Joe is a portfolio manager, wealth advisor, and investment advisor at Bakish Wealth at the firm Richardson Wealth Limited. He was named Canada's top under 40 investment advisor in 2020 by the Investment Industry Association of Canada. And Joe has built his career by focusing on the interests of his clients. After initially building a strong practice at Investors Group, Joe recognized the need for change as the industry was evolving, and Bakish Wealth joined Richardson Wealth 6 years ago, which has opened the door to a wider universe of alternative assets with the aim to enhance portfolio diversification, from private equity to real estate and private debt. This has led to a growing referral base, and Bakish Wealth now has $242 million in assets under management across 490 households, including an insurance component. Most of their clients are between 40 and 60 years of age. Many are research-oriented physicians, medical researchers, and university professors. Their clients also include high net worth business owners and high potential young professionals. And for prospects with established careers, their minimum investment is $1 million. Now, one thing I will mention is that there is a sporadic creaking noise in the interview when Joe was talking. I thought at first it may be me sniffling, but I couldn't edit it out. And it turns out that it's one of us moving around in our chair, probably because we're having a hard time containing our enthusiasm on some of the concepts we discussed today. But nevertheless, it's sporadic. It still turned out to be a really good interview. And with that, please enjoy my conversation with Joe Bakish. Hey, Joe, welcome to the podcast. I'm super pumped to have you on today to talk about alternative investments. And where does the podcast find you?
Well, I'm here in my basement in beautiful Pointe Claire, which is a suburb outside of Montreal.
Awesome, Joe. So we definitely live in very interesting times because recently what's been happening is that stocks and bonds have been going down together. And typically we have bonds that may offset some of the pain when it comes with stock market declines, but we're not seeing that right now. So we're seeing a positive correlation. And maybe this is going to be short term because we've seen this happen in the past during inflationary periods. But what I'm curious is, does this positive correlation between stocks and bonds, does it have any implications when you go ahead and construct a portfolio, if any?
Yeah, absolutely. But just before I answer the question, I want to let all your listeners know that they're very lucky to have you help them guide them through a lot of complex topics. I had the chance to listen to several of your podcasts. I really actually look up to some of the people you've interviewed. And so I'm happy to be amongst them now. And hopefully you can add a nice little segment and additional information to complete your body of knowledge, or at least to add to it. And I'm happy we're talking about alternatives because it goes to the exact point of your question, which is non correlated assets that are particularly.
Joe, thanks for those kind words, though. Thank you. It means a lot. And I have to say that you came with really rave reviews. So we had a chance to connect before over the phone, and I really enjoyed our conversation. So I'm stoked to have you on.
Oh, great. Well, thank you. I'll
Yeah.
do my best. Now it's time for me to, give you some good stuff. So, yeah. So, essentially, I think it's important people understand what the definition of an alternative asset is, because there's a lot of murkiness around that field. But what's interesting is alternative assets have actually been around longer than stocks and bonds. If you look at agriculture, if you look at commodities, if you look at real estate, that's all been around for quite some time. And the definition really falls under 5 different categories, where you have hedge funds, which is what I also call strategies. So that's like going long or short, which we could talk about those definitions afterwards. There's private assets. So that could be like private equity and private debt. There's commodities, which is pretty self-explanatory, I think, like gold and copper and nickel. There's real estate, obviously pretty self-explanatory, but real estate breaks down into so many different categories that you can get quite a lot of diversification just in that asset class alone. And of course, there's infrastructure, bridges, ports. And so to go back to your question about stocks and bonds right now being positively correlated, a lot of these alternative asset classes are actually not. Just look at commodities. I mean, we happen to be in and when I say commodities, it actually comes under natural resources. So we could look at land as well. And so they're really able to give a nice angle of diversification within a portfolio. So I'm not sure how you want to go about portfolio construction, because there's a number of different ways we can look at it. But ultimately, what we want to do is have elements in the portfolio that aren't going to be going down when the other ones are going up. So that way it smooths out the ride, but doesn't necessarily take away from your ultimate end goal of your return objective. And so it just so happens over the last 5 years, there's been a lot of what you probably read about as democratizing these asset classes. In other words, fintech and financial innovation have really allowed for access to what was typically reserved, for minimum $5 million check size, $10 million check size, a lot of high illiquidity. I'm sure we're going to get into some of those characteristics of alternative investments later, but a lot of the barriers to entry, for better or for worse, because one has to be careful in this space, are coming down. And so that allows for a much more solid portfolio construction, which really based itself on the pension plan. But we could talk about that throughout the presentation.
Yeah. That's great. Lots to pick away at there. The asset classes within alternatives that you mentioned, I like, because I can tell you what, Joe, when I was doing a little bit of prep for this podcast, I listened to a few podcasts on alternatives, and all I kept coming across was crypto, NFTs, fine wines, fine arts. And so I guess maybe the best way to kind of approach it is traditional versus non-traditional, or maybe tradable versus non-tradable alternative assets, because we hear about a lot of other stuff, but I think the ones that you mentioned, commodities, real estate, infrastructure, those seem to be the more kind of true or traditional alternative assets, right?
Well, for sure. I mean, if you look at something like the crypto space, it's been around for 10 years, but really only gained popularity the last 3.5, and it's still quite nascent. Speculative. There aren't very many cash flows, if any, that come out of it. Maybe the exchanges, there's some good fees that come out of the exchanges, but and then if you look at the NFTs, even more nascent. But the fine wines, those have been around a long time, and they actually make for some very interesting portfolio diversification benefits. In fact, I got to interview a couple interesting, what I'm not going to say esoteric, exotic perhaps. So music royalties, fine wines, and then another interesting asset, life settlements. So what can also be called death bonds. So totally non-correlated to the market.
I didn't even think about music royalties, and this came up on a round of golf about a month ago. I was playing with one of my friends, and he told me he was into this. So it's pretty interesting stuff. So you mentioned Canada Pension Plan, Joe. So when I last took a look at how they are invested, I think as of end of March, I think only 25% of their portfolio, give or take, was in public equities, and the rest was just spread across. Is this an approach that you and your firm take as well? Just curious, broadly speaking.
Yeah, for sure. So quick little background on our firm first. I'm a partner at Richardson Wealth, portfolio manager, and the firm manages about 37 billion in assets across the country. It's wholly Canadian owned, and it's essentially a financial arm of the Richardson family. And if you actually Google the Richardson family, they're one of the oldest families legacies in Canada. I think the Richardson Corporation is old. This is the longest running business in the country, which is
Hmm.
interesting. And that's one of the reasons why we chose to partner with them, because the entrepreneurial spirit, the fact that they give us latitude, real flexibility in constructing our portfolios. So we're not very limited to either product shelf or even ranges of
Uh-huh.
alternatives. To go to your Canada pension plan question, there could be advisors that want to do that, but maybe they're limited on their allocation percentages just based on firm policies.
Hmm.
And in our case at Richardson, they're very open with what they allow us to do, which is very helpful because we do, I do quite a few presentations to physicians such as yourself,
Yep.
in a community. And what I often highlight is that Canada is a very innovative place in the sense that, ETFs were actually created here. And if you look at our pension modeling system,
Hmm.
it's like actually the envy of the world. The Ontario Teachers Pension, the Canadian Pension Plan, they were one of the first to actually go and buy private assets directly and not just buy publicly traded securities. And now it's at the point where if you actually graph it over time, that it went from a 60-40 bond stock mix to what you had highlighted 20% only. And what I also find interesting is the Canadian pension plan only has about a 3.5% allocation to Canadian equities,
Wow.
which is interesting.
Yeah, that
I
is
think it's a
really
good
low
thing.
compared to most of us. Yeah, yeah, that's
Very
interesting.
low, very low, very low, like a third, and so, or maybe even a quarter, or
Yeah,
depending. Some people are all Canadian banks, right? So it could be, but Canada only represents like 4% of the world economy anyway. So it
yep,
actually does make sense from that standpoint, not to be over concentrated. And
absolutely.
we're seeing it now with Canada being a resource based economy, and that actually helping shelter some of the downside when it's almost naturally like an alternative asset in Canada because of that
Interesting.
weight of natural resources that are in our indexes. Uh, that's not to say that that's how you should get exposure, because I have a philosophy on what I like most about alternatives. But yeah, certainly the Canadian pension plan and that pension model is what we aim for. And finding unique opportunities in those areas.
Joe, before we move on, I realized I didn't really give you a chance to tell us a bit about yourself. Like, I'd love to give you that chance. I think I just got too excited about the topic. So,
Yeah, no
yeah, if you
problem.
if you if you want to just tell us a little bit more about yourself, your philosophy, what you do, because I know you're very knowledgeable. You're a very good teacher. So, I want to give you a bit of time.
Thank you. Well, I think the most important place to start is with the kids. So, and of course, my lovely spouse. So, I work together with my spouse for 4 years now, and it's working very nice. She takes care of our business development, Connie.
Hmm.
And then the three kids we have are, as we were talking earlier, are 7, and that's Abigail. The twins are 5. Oscar and Eva, so boy girl combo. And so it kept my hands really full, for I would say the last year and a half has been much easier. And then in terms of, what I like to do, typically I like to do this portfolio construction. I like to educate my clients as much as I can, help them along the road to what their objectives are. But in my spare time, I like to, play tennis, obviously hang out with my kids, rarely golf, and really be involved in our community. And there's a number of initiatives that I could talk about at length if you'd like, but it's really just to give back to the things that made a difference to me as I was growing up.
That's amazing, Joe. Golf is infrequent for both of us, but maybe if you're in the Toronto area, we'll get to play sometime. Um,
Sure.
so back to alternatives, Joe. Maybe you can talk to us about your rationale for investing in alternatives. Is it simply diversification? Is it more downside protection, maybe through in alternatives at times being uncorrelated to stock market returns, or in today's era? Is it more seeking that ideal inflation hedge? I know the data for that may be a bit limited, but talk to us about your rationale, your true north when it comes to alternatives.
Yeah. So, before alternatives really became available for retail investors and accredited investors, even, you learn when you sort of do your finance 101, that diversification is the only free lunch. And so,
Hmm.
first and foremost, we try and get diversification across all asset classes. And now those many of them have become available where historically they weren't. So that's, I would say, is one of the most important benefits of adding
Hmm.
a wedge of alternatives. That being said, there are other ways to look at them. So you can have alternatives that you get for growth, right?
Hmm.
So that's what I call a return enhancer. Or you can have alternatives that are good for stability, which I essentially call like a volatility manager.
Hmm.
And those combinations essentially can determine where you are in the risk spectrum. So if you're higher risk, you could go for more growth oriented alternatives. If
Hmm.
you're more of an income desiring investor or lower risk, then you can go with assets that could produce more income. That's
Okay.
not to say that those income type of alternatives provide low returns. In fact, they can provide quite compelling returns. It's just the nature of the client experience, if you will, the investor experience. So are they going to see large pops on value, or are they going to see steady, distributions come into their accounts
Hmm.
that they can either spend or reinvest? But ultimately, we like to use it to just in 2017, we were kind of saying stock markets are at all-time highs, yields are at all-time lows, like treasury yields are at all-time lows. So if rates start to rise, that's not going to have a good impact on either of those asset classes.
Hmm.
So we need to look into these types of assets to be able to get negative correlation or less positive correlation. The lower, the better. So 2018, we looked really smart because if you recall, in October and December, rates rose, stock markets
Hmm.
came down,
Hmm.
our portfolio weathered it quite well. But then 2019, not sure what happened there, but rates started to be cut. I guess inflation didn't show up. So they were able to be more flexible with the interest rate policy. And then, of course, COVID sort of kicked into place. So that brought rates even lower and put stocks even higher. So it disconnected the stock market even more from reality. And then now we're really seeing a nice payoff with the alternatives on that stability factor.
Okay, you mentioned earlier that alternatives will often be uncorrelated to stocks. I was trying to dig into it, look for some evidence, found some scattered evidence, but Joe, what is the evidence for that? Maybe you can just walk us through
Yeah.
it.
So, in some panels, I was asked how I benchmark the portfolios. And so, what I always tell people is I say, look, if you were to take a 60-40 mix, so 60% equity, 40% bonds, and you were to look at the last sort of 25 years of returns, and then you would then have a complement where you add like, a 25% mix of real estate, private debt, private equity, those asset classes we were, shouldn't say those types of investments we were talking about initially, that actually skews the portfolio so that you have less volatility and higher return. Um, and so that's really how I like to say is like, what would it be for the retail investor who could get basically diversification for free, in the form of a globally diversified ETF, and there's a number of providers. So that's them doing that for free, very easy, very turnkey. What would be the effect by adding a number of alternatives to that mix? And when you just do it that way, you actually see that there's a difference in return. And so that's the evidence that I like. And there's also, when you look at the Canadian pension plan, they kind of show you that as well.
So, in terms of one of these alternative asset classes, so I did a bit of digging into alternative private lending, and I think that this, in fact, makes up about 15% of the Canada pension plan today. So it's quite significant. So I think J.P. Morgan put out a paper in 2018, and they were comparing the volatility and returns of private lending when compared to other types of fixed income instruments, so corporate bonds, government bonds, high yield bonds. And they showed that not only was private lending less volatile, but that the returns were a bit higher. Can you talk to us a bit about private lending? Because a lot of us aren't that familiar with it. What do we need to know about this type of asset class?
Well, it's timely that you asked that question because in Canada right now, there's a huge legal case happening over one of the biggest private lenders, which is bridging finance. And you really have to be careful with how you invest in private lending because the quality of the loans really determine, the sustainability of that private lender. So we like to go with really large institutional private debt providers. And yes, to your point, if you run the models, you could see that the private debt does enhance return because what you're ultimately doing is you're substituting bonds, which were having traditionally low yields. And
Hmm.
ultimately, a lot of people were moving into alts for, they were striving for yield. They were reaching for yield. They wanted a higher return because back when interest rates were 8%, that's a pretty good yield that you could rely on for, retirees and for growth. But now that interest rates are, around the 3% area, and like last year, obviously even worse, you really need to find something else to make your portfolio sustainable. But with that comes additional risk and different kinds of risks. So you really want to look at the underwriting of the loans. And when you get into a larger scale, that becomes difficult. So you have to have a lot of trust in the managers.
Hmm.
And then there's another, case in Canada as well, with Nine Point, where their involvement with bridging has caused them to be painted with the same brush. And so, yes, you can get higher returns, and yes, it can be smoother because it's not mark to market every day, which is almost like artificially volatility management.
Yeah.
Because it could go, it could be $10, $10, $10, and then go down to five, right?
Yeah.
And or it could be like bonds, where you could see as rates go up, it's gradually coming down.
I'm going to just take this and jump ship to one of my later questions, and we'll come back to some other things. So this brings me to the topic of due diligence. So what you're talking about private lending and how one has to be cautious in terms of how these loans are made and to who these loans are made. So can you talk to us about this process of due diligence, Joe? Because I just want to know, how does your firm kind of go about conducting due diligence and figuring out which asset classes to invest in? And maybe can you share with us a time when this worked really well and a time when this failed? Because what triggered this question for me was, I read in April, I think that there were 4 pension plans in Canada. They had invested in pipelines that were moving oil out of Russia. And because of the war, that had a huge impact. Now, while that's
Yeah,
an
zero
extreme
value.
example, yeah. While that is a bit of an extreme example, I think that the unexpected can happen. And so due diligence, maybe just talk to us about how you do it and when it worked and maybe when it didn't.
Yeah, and to your listeners, I would say that that's probably one of the most important questions to ask your advisor is, what is your process for determining, each individual holding that we own?
Yeah.
Because it's certainly going to be impossible for the portfolio manager to be an expert in private equity, and be an expert in private debt, and be an expert in currencies and commodities. And so therefore they need to delegate that to managers. And so what's their process in doing so? So at Richardson, we're fortunate where we have a back office who has a portfolio construction committee. They have a fiduciary obligation to the actual investors, not to me, not to them, but to
Okay.
the investors. And then so they have to go through a pretty they go through a strict set of due diligence protocols where they interview the managers, they visit the site, they look at the underlyings of the holdings, and they really demand as much information as possible.
Hmm.
Because a lot of with private assets becomes a little murky. So if they don't understand where the returns are coming from or where the volatility is coming from, they usually don't approve it. And it comes out to like about a 120-page document that they come up with. Then and I trust them to do it, which is one of the reasons why we're partners with Richardson, because of our scale, we're able to get some of the
Hmm.
best opportunities. Um, Plus, with our team doing that homework, it really helps to make my life easier because I'm already selecting from I could use some of that due diligence when I look at it and see how it fits into our client models, and
Hmm.
sometimes specifically for clients specifically because maybe they have different objectives. Well, certainly they have different objectives, but some people have slight preferences for one over the other. So if you think about private debt, what do you want to look for there? It's basically two things. It's the quality of the cash flows. So, how are the lenders, um, the businesses that they're running, are they able to have like business cycle protection so that they can continually pay the coupons or the interest? And then it's like collection. So it's like, if anything happens, what kind of collateral do you have? And I would say, like in 2021, 2020, loans were just being no one was collateralizing their loans. It was like there was no covenants, which are basically like extra conditions that allow you to get assets in the event that someone defaults on their debt. Or there's conditions if they can't make a certain payment, they have to put up more capital. And that usually is a sign that things are at very risky points. When people are willing to lend with fewer conditions, that's usually a time to sort of really be careful, because those conditions are there to protect the end investor, and basically ensure the continuity of the cash flows.
Is there ever a time? I appreciate that transparency when it comes to due diligence. There's a lot that's obviously going on behind the scenes. Is there ever a time, Joe, where this process just didn't work and there was a suboptimal outcome with respect to an investment? Tough question, but I just wanted to throw it out there.
I think every portfolio manager goes through that, where, they've done everything they possibly can, and then there could be fraud, that happens. And what's the suboptimal outcome? Well, it's investor losses and it's compensation losses for the advisor. So it's a lose-lose for everybody. No one likes to see that. It affects track record. But the way to avoid that is really not to have concentrated positions, and have diversified positions that are invested in institutional style managers. Because the more local you get, you typically, because there are a lot of small private lenders, but they come with higher returns typically, but there's often higher risk there and tons of concentration. Instead of thousands of loans, maybe there's a dozen loans. And so you can set yourself up nicely to avoid those traps by really, not getting too greedy, but just going for the non-correlated return that's reasonable. You don't need 13% to retire successfully, right?
Yeah, exactly.
And if you're getting 13%, there's a reason for that.
Let's move on to illiquidity, because this is a term that comes up a lot in the alternative investment space. And so I view it as a bit of a double-edged sword, Joe. For me, illiquidity can be a bad thing because sometimes we need the money personally, and sometimes we need to be able to rebalance. So I wonder if that process can become more challenging. But at the same time, sometimes illiquidity can be a good thing because it prevents investor emotions from seizing the day and dictating returns. So talk to us about illiquidity. What's your take on it? What do we need to understand about this?
Yeah, so interestingly, when we present our models to our clients, the first thing we highlight is what we want to do is exchange some market risk and interest rate risk for liquidity risk. And that's particularly useful to do inside of a LIRA, like a locked-in retirement plan or an RSP, because in many cases, those assets won't be sold. And if you do want to liquidate them to cash and take them out and spend it, there's a lot of tax ramifications. So we always try and concentrate our clients' alternatives either in their corporate assets, like if they're, with their holdco, and that way it allows, that almost is like another RSP if you think about it. It's a tax deferral mechanism, or in their RSPs. We try and avoid doing it in TFSAs, even though we can get a lot of growth, because there's a little bit of mental bucketing that happens with clients where they may think the TFSA is available and they forget about the illiquidity. So, yes, I mean, like a GIC, like if you have a 5-year GIC, that typically pays more than a 1-year GIC, guaranteed investment certificate. And that makes sense because you're willing to forego that cash flow. And in the alternative space, that allows the managers to know that the cash flows that they're dealing with from investors are solid and they can't just be pulled out. Now, I was talking initially about this availability and democratization of alternative asset classes. And one of the issues is liquidity. So everyone wants liquidity and higher return. I'm okay with having illiquid assets because true illiquidity is actually the real way to invest when it comes to like long-term investing. We don't want to be trading and buying and selling. But a lot of the providers are indicating, hey, we can give you liquidity in 30 days. We can give it to you in 60 days. Maybe we can even give it to you weekly. And that works until it doesn't, because they can often gate it, or they can often, basically close down redemptions. And that is when I think investors really start to get nervous, is when they're told they can get liquidity and then all of a sudden there's a run on that asset and then they can no longer get it and then it's locked up. So that's a risk. The other issue, which is really pertinent in portfolio management, is the ability to rebalance. So certainly if you look at like a private equity holding, that we own, you can only sell it at the end of the year, which means in a time like now where it's done very well, maybe we want to sell some of it to be able to buy, something that hasn't done very well, just to rebalance because we need to keep to our percentages. Well, we'd have to wait, right? So you really have to have a much more disciplined approach, and you really need to know your liquidity windows. And so you're not necessarily rebalancing for the sake of being tactical, but rebalancing for the sake of staying within your windows and just sticking to that discipline over time. So sometimes it is a bit frustrating when you see you have this asset that's done very well while everything else is done poorly, and you want to be able to take advantage. But that's also been a benefit too, because the asset had continued to do poorly, or or the other asset that was up has continued to gone up even more. So it's really market timing is never something we suggest, but it's keeping the discipline to rebalance. And if you do have a proper plan, then it's expected that you can, it's overweight now, so we can set up the sale for a year from now. And that's really the timeframes that you want to be talking about with investment decisions. This never should be a day-to-day quick
Yeah.
decision. It really should be a planned process that you can execute on as markets evolve.
If we go back to March 2020, I mean, that drawdown was a lot shorter than a lot of people envisioned. So looking back, it was really only 4 weeks from peak to trough. Were there any issues in terms of liquidating certain assets to take advantage of the markets at that time for your firm?
Yeah, so we had some assets that we were able to sell and turn around to get cash. And we did learn from that, actually, because um, when we did want to sell some of the assets, it was very difficult. And so they kept their value, they did what they needed to do, but maybe we sacrificed a little of return because we couldn't be as tactical. And there are some moments, like in pure panic situations, that it does pay to be tactical if you have the cash to do it. When things get so cheap, it's very hard. I mean, it's like Warren Buffett eventually, right? Be greedy when others are fearful, right? So when that happens, you want to have the ability to do it. So we've learned from that March 2020 to be able to go through it. But March 2020 was very unique because it wasn't just an economic issue, it was a health issue. So people almost conflated the two. And as a result, you had policy at both the fiscal level, so government spending, and at the monetary level, which, central banks, they lowered their rates, they started buying bonds and mortgages, and then the governments basically flooded the money with cash, flooded the system with cash as well. So that's where you had this ridiculous recovery that was so steep. And now we're kind of dealing with that hangover, if you will, because we have to readjust to go back to the point where money actually has a cost, which is in the form of interest rates. And so yes, I think in March 2020, there was a lot of opportunities, but it could have been far worse depending on the reaction from the authorities. And then, we have to remember, there was a vaccine that was created in like a year, which is like pretty miraculous. And no one really understood that was going to happen, right? So that got us a long ways out of the woods. Although we're still in a pandemic now, so it's hard to judge if that's over. But I would say that now, not that I want to time the markets, but we're in a period where we could be in a more prolonged down cycle versus this sharp V-like recovery that a lot of investors have become accustomed to. And this really goes back to the financial crisis, because it was almost like an extend and pretend or a delay and pray mentality for the last 10 years, or I'd say 13 years. And the pandemic just made that a little bit longer than probably was planned. So now we'll see, as rates come up, where the speculative bubbles have sort of begin to. Now we'll see if they burst and where they burst and how they burst, and that's normal. You need to have a system cleanse from time to time.
100% agree. So rates are going up. Inflation seems to be getting higher and higher every month. I think the latest readings in May were around 8.6%. So not ideal, but everyone's looking for the ideal inflation hedge. And Joe, what I'm wondering is there any evidence, whether it be historical through papers or through your experience, that alternatives do offer an inflation hedge?
Yeah. So, I mean, we say alternatives. There are some that will and some that won't. I would say that the ones that are able to pass on their costs or that are inputs will be able to deal with inflation the best. I'd also say that, 2 years ago, gas or oil was traded at negative value, and now it's at $120 a barrel. So when you talk about inflation, it's relative to a very low point, almost deflationary, right? I'd also say that everyone's saying interest rates are so high, but historically they're still very low. So it could be we have a little bit more ways to go. The problem is that we have way more debt now than we used to, both at a corporate level and a personal level, at least in Canada, and of course a government level. So interest rates will have more of an effect than they would have had in previous times. And so absolutely, inflation is here. We see it in the grocery stores. We see it when whatever we buy could be a bicycle for my kid, which is why I'm a big fan of using Kijiji now and Facebook
Yeah.
Marketplace. Um, but yeah, I mean, I think that there are great alternative assets that could hedge. Infrastructure is a good example. Commodities are a good example. Depending on the type of land could be a good example. Um, but obviously, it's very dependent. You can't just say infrastructure and that's it. You need to go into a specific type of infrastructures.
One paper I came across was titled U.S. Inflation and Growth or Asset Returns, Global Asset Returns. I think it was published in 2021. So kind of to your point, what it mentioned, I think the big take-home point was that many asset classes did okay, generated some returns during high and low inflationary periods, but the asset classes that tended to stand out, energy was the highest, followed by commodities, and then utilities and infrastructure did quite well, although energy and commodities were quite volatile. But I think so. Speaking to your point, that paper definitely supports what you're saying. So
I'm sorry to cut you off there, Yatin, but real estate as well, because if you just look at the inputs, like the building materials, if it's more expensive to build beside you, and you already have the building built and it's in good condition, and you're able to raise your rents a little bit faster because maybe you have some contractual elements built into it. I mean, that's a great inflation hedge too. But if you're in a building that's older that needs to be replaced, or
yeah,
if you have leases that are very long and
hmm
without any, if there's rent control, that's where you might run into problems. So it's just another example of how you could say real estate is, but there are also some real estate investments which are not great inflation hedges.
no, that's a great point. So Joe, that brings me to my next question. When you look at all the different types of assets available in the alternative space and everything that's happening in our lives right now, so inflation and the positive correlation between stocks and bonds, of the different types of assets that we've kind of discussed, like real estate, infrastructure, land, are there certain things that you are kind of leaning towards in the alternative space right now?
Yeah, so definitely, well, I don't like the market time, but I think an all of the above approach is really important. Just like you want to
hmm
diversify your stocks and bonds, you also want to diversify your asset class in the alternative
hmm
section. So not being overweight any one type or one holding is important, but trying to get like just that effect it would have on the overall portfolio what the desired purpose is here. And so, yeah, we like all of them. We don't really have much hedge fund exposure
Yep.
because that to me just historically hasn't really, it's either a home run or it's
Yep.
nothing, and they often more often than not it's nothing. So how do you pick the manager? Whereas with private capital and natural resources and real estate infrastructure, those are the ones I think that you can certainly have wedges of in today's environment, and they'll do you well whether it's an expansion, deflation. I think that it's just almost like a necessary part of a recipe.
Joe, can we talk a little bit about private equity? Because when I last looked at the Canadian pension plan, I think it was almost one third private equity, which I found very interesting. And then when you look at the last decade, I think the kind of the gap between returns, when you compare private equity returns to public equities, that gap seems to have been narrowing. And so we have two camps of people. One camp will say that, okay, public equities performed exceptionally well in this period, thereby narrowing the gap. And other people will say, private equity is a space that is becoming more and more competitive with time. And anytime you have more competition, the chance for outperformance and excessive returns probably diminishes. What's your take on all of this?
Yeah, so not all private equity is created equal, but you definitely want to look at the leverage that's embedded in private equity. CFA Institute had an interesting report about a year and a half ago that looked at small cap stocks that were levered up, and then they essentially equaled the return of private equity. So it's not like you had to pay a manager 2% and a 20% performance fee. You're able to do it basically for free for yourself. But obviously, that's a very simplified scenario. I think when you look to invest in private equity, it's all about the quality of businesses. I think that there's been a huge shift, like you're saying, from public markets to private markets. But private markets are actually a greater part of the economy than the public markets are. There's more money,
hmm
anyways, and more value in the businesses in private. So
hmm
arguably, it should be a bigger component of a portfolio, but it's not liquid, and so it's not suitable for everybody. Funds have tried to make it a little bit easier to access and a little bit easier to sell, but again, that's all based on when things are good, it's easy, but if things become more challenging, then you'll have gates, and it'll be more challenging for the fund itself to be able to provide cash, because nobody wants to hold cash in those types of situations because it's a drag on the performance, especially when you have leverage and you're holding cash earning you nothing, but you're paying like an interest. So is it becoming too trendy? I think there's a lot of room for this to run. I think that, as with, I don't want to be repetitive, but it's a necessary part of the portfolio. So it shouldn't be all or nothing, right? It
Hmm.
should just be a disciplined uh, disciplined percentage that you keep and that you try and diversify as much as possible, because private equity has leveraged buyouts,
Yeah.
secondaries. There's a number of different types of private equity that enable you to get that exposure. And why not try and get all of it? Direct investing is also quite interesting. I like the fact that people are learning more and more about private equity, but you certainly want to do your due diligence on the manager to make sure that they're, not just leveraging up to a high degree to get outsized returns. And I mean, we'll see if public equity does catch up, which I don't think it will, because it's typically not as levered. Um, then obviously it loses a lot of its luster.
Now, one astute DIY investor asked me this question, and I thought it was interesting. So, this person basically said that the stock markets, so public equities, over the long run, they only go up. You're going to have bouts of volatility, but those bouts of volatility are just a temporary interruption of a permanent uptrend. So, with that in mind, if I'm thinking long term, I this individual said I don't need to diversify away from that and go into the alternative investment space, pay the associated fees. How do you address that if somebody brings this up?
Yeah, no. Firstly, I always like to go back to the Research Institute, Dalbar, which is out of Massachusetts.
Hmm.
They every year publish a study called the QAIB, which is the quantitative analysis of investor behavior. And without fail, pretty much every single year, they look at the average investor and they compare
Hmm.
it to their equity benchmark,
Hmm.
indexed benchmark. And pretty much every year, the investor underperforms the same fund that they're investing in. Why is that? Well, because of market timing and emotions. So if we were, purely rational man type investors, you could definitely do a great job buying long only equity and holding it for a period of time. But so many people have proven that they can't do that. Um, and at the same time, there's a case to be made for alternatives giving higher rates of return. So even if you just, in both cases, close your eyes for 30 years and then you open them up, ideally you'd want the higher rate of return scenario. And there is a big case for, private equity and certain types of real estate in giving you that higher return, not just the volatility management, which is, I think, what the investor you're speaking with is referring to. Like, just don't sell the dips and just keep buy and hold, and it doesn't matter what happens, right? So I think that would be the ideal behavior. But just last year, the S&P 500 performed at 28%, and the equivalent investor was 18. That's a 10% difference, and that's the
Yeah.
largest difference. That's the third largest difference on record since
Yeah.
1985 that they've been doing the studies.
Wow. Wow. Okay. Yeah, that is significant. So I think your points are all well taken there. Joe, can we talk a little bit about farmland? This is a really interesting asset class, and when I go back and try to track how it's performed, it seems like it's performed really, really well. Like there are probably very few asset classes, maybe just the kind of the Dow Jones REIT index that maybe slightly outperformed farmland over the last several decades. Talk to us about farmland and kind of what we need to know.
Sure. And I'll just say, like, I really like to get access to our alternatives privately, not so much through indexes. A lot of the alternatives, it's very hard to index them. And so the indexes themselves don't do the job necessary. So if you just had an infrastructure index in your portfolio versus a private infrastructure, LP or,
Hmm.
even just a mutual fund, there's a difference. There's going to be a big difference in performance because the index is typically all publicly traded securities, which are going to have lots of volatility. And
Hmm.
whereas the private is obviously not marked to a daily markets, it's really a long-term pricing every year. Um, and so that's important. So when you look at farming, for example, the largest investor in U.S. farmland, not that I like to do the lemming approach where you just follow the leader, but it's Bill Gates, which is very interesting. Um, and my view, particularly in Canada, this is another potential Canadian success story, is that farmland, if you just look at the price of food and you look at the effect of climate change on soil quality throughout the world, we're actually looking to have better soils in Canada. We certainly have water, arguably too much water with the flooding that's happening.
Mm-hmm.
But ultimately, we'll have more diversification of our crops than we do now. And so, farmland, and when we say that, we're not talking about buying soy or buying corn or buying wheat. It's really the land itself.
Mm-hmm.
And that's a big differentiator from buying the commodity, because the commodity is going to be extremely volatile. Whereas a good year in wheat, for example, is what's happening now, but who knows what happens the following years. Whereas the land itself, if it's sustainably maintained, actually improves in value pretty significantly, mainly because the fact that the crops themselves on average go up in price and there's a limited amount of farmland. So I think, like a little bit of anything, everything is good in a way. So having an exposure to farmland, if you can get it, because it's not exactly easy, is a great portfolio diversifier that can provide you with pretty nice appreciation.
So we've talked about a lot of different investments today, Joe, within the alternative space. I'm just curious, is there one that stands out in your mind as being overhyped in the alternative space? And maybe is there one that stands out in terms of being a little underrated or underhyped?
So putting the crypto world aside, because that would definitely get the overhyped, I would say right now, private debt is everyone's trying to go for private debt. It's being marketed as, very stable with high rates of return. And I think that there's risk there. So, and at the same time, as rates go up, that means that people are getting closer to a reasonable rate of return on just publicly traded assets or more safe assets, right? So the need to go into the higher risk or the private illiquid nature becomes less significant. Although we definitely still suggest having private debt in a model, that would be one that we're seeing a lot. We're also seeing a lot of infrastructure. People are very excited about infrastructure. And again, I think it's important to have a part of the portfolio there, but there's just so much money being invested across the world in rebuilding ports and this, energy infrastructure 2.0, where we electrify the grid and everything. You never know how that's going to play out when there's a big move of money in that direction. In terms of what we love, we try not to have a bias. Farmland would be great to say, but I mean, it could be a 50-year long play, right, as opposed to a 10-year long play. So I can't really say that there's okay. So secondaries are very interesting in private equity, actually. So if you can negotiate discounts, any asset that you could buy at a significant discount to its cash flows, those are what interest us the most, simply put. Okay. So it could be in any asset class, but if you're able to get a discount on the purchase price and it's, still going to be providing its solid cash flows or still have appreciation, then and you can negotiate the price of something, I think that there's a lot of attraction there.
You mentioned secondaries. What does that mean exactly?
Okay, so secondary is essentially you have private equity, and so you have funds, primaries, right? They just launch a new fund, for example, they open it up, they raise money, they then close it. And so imagine your pension fund A, and you own that fund. Well, sometimes you want to actually sell it because it's a smaller position. Maybe you've changed your, direction, and so there's actually a market for people to buy it from you. So a fund that's already been issued is called a secondary.
Gotcha. Okay.
And so in many cases, those are often able to be purchased at discounts for a number of reasons. And so that makes it like a great little private equity overweight. Like if you were to look at the different kinds of private equity, secondaries being one of them, you can be a little overweight on that one. But I mean, it's going to be different for everyone. So,
and Joe, any final words of wisdom, of advice, anything?
Yeah. Always. So I do like what your astute investor said about buying and holding and not looking at your statements. So, I was reading an article. If you have a problem with all the downside you're seeing in bonds and stocks now, a great technique is just to close your eyes. So
that's what I do. I'm ignorant. Yeah.
And honestly, a quick anecdote is there was I think it was Wells Fargo or Morgan Stanley. I can't remember, but and maybe neither of those two, but they had three accounts. They had a high active trading account. They had an account of traders that were very infrequent. And then they had a series of accounts from people that were deceased. And the best performers were the deceased accounts because there was like no activity. They were able to do the buy and hold. And so sticking to a disciplined process, being properly diversified with alternatives that are not just mimicking like the public market beta, but actually provide real diversification. And then having a savings, consistent savings plan and not trying to time the market are all, in my view, easy to say but hard to do activities that will really help you with your objectives, your long-term investment objectives, whatever they may be.
Great advice, Joe. And if people wanted to reach out to you, what's the best way to do so?
Well, I'm all over. I have my website. They can email you, Yatin. And then, but if you just Google us, Bakish Wealth, it'll come up. I'm happy to provide my coordinates after if you'd like. But generally speaking, we get people, majority of our clients come from referrals. So it's our existing clients who have colleagues or friends that they can also benefit. And then they email in or call in. And then we do a lot of educational activities, which we get some clients from, but it mainly is just to get good financial literacy in the system.
Joe, I think one of the reasons this topic excited me so much is that so much of our attention and bandwidth goes to the day-to-day, the noise. And so we're constantly reading about stocks and trying to hit that home run. And I think that in my mind, it's best to educate ourselves and look at all the available possibilities. So thank you for coming on and giving us some very, very useful content. I think you explained things really, really well. That's why I was excited to have you on. So thank you.
Yeah, well, I hope that all sits well with your viewers. And of course, if they want to dive deeper, there's many different ways to go. And I'm happy to contribute alongside all of the other great people you've interviewed in the past. So looking forward to diving deeper with you, Yatin.
Hey, thanks for that, Joe. And have fun golfing today. Keep it in the short grass.
Yeah.
Okay. Take care. Take care. Bye. Thank you so much again for taking the time to join me. If you found the content useful and you think others could benefit, please feel free to share the episode. And if you feel compelled, feel free to leave me a rating or review. I am always very grateful for that. And of course, reach out anytime, especially LinkedIn or BeyondMD Podcast at gmail.com. And we'll see you in about 3 weeks. Stay well and stay savvy.